The markets have fallen a bit and we've seen an uptick in volatility. One of the things we're going to talk about today is whether changes in volatility can be a signal in and of themselves where you can get long or short stocks today on Open Interest. Hello everybody and welcome. I'm Mike Coe and welcome to Open Mic. So we've seen an uptick in volatility today. The VIX is a little bit higher. A big cause of that, of course, is the fact that Nvidia is going to be reporting earnings this week. This is pretty meaningful. Nvidia is implying a move of over 10% after they report so we're looking at a move of about 10.7% implied between now and Friday after they report earnings. That's really meaningful for the markets because Nvidia is such a chunky piece of the market. So it's about 6.5% of the S&P 500. It's similarly a very large chunk of the NASDAQ index. The aggregate level of US equities in round numbers, we'll say, is about 50 trillion. And of course, the value of Nvidia is also measured in the single-digit trillions. So you factor a $3.1 trillion market capitalization times we'll just again use round numbers, 10% implied move. That's a $300 billion market cap swing in just one of the stocks in the broad market. But if we do a little bit of math, that's 6%, right? That's a 6% move of the aggregate level of US publicly traded equities that can be attributed to the move that is currently implied by options on Nvidia alone. And of course, the interesting thing there is that presumably there will be knock-on effects as well, right? It's not just going to be Nvidia that moves. Other stocks that have participated in the same story, companies like Broadcom and so on, we would similarly expect to see them move even though they may or may not be reporting meaningful results at the moment. And all of this got me thinking about something, which is that, first of all, the implied move, the price of 1 month options in Nvidia is about as high as it has been for any of the past 8 reported quarters. So why don't we take a quick peek at that, and then I'm going to get to what sort of has me a little bit concerned, if we can put it this way. So first I'm just going to go back here. I'm going to go back to August 1st of 2022. I think they reported on the 21st or 22nd that year. So by doing this, I'm just going to ensure that I capture at least 8 reported quarters. And let me just throw those in. There we go. Okay, so if you are looking at this, you can now see, and I'm going to get rid of the historical volatility, and I'm just going to put, let me just put 1 month vol in. So this is 30-day implied volatility, and I just made those events disappear when I did that. Okay, so here we are. Now I'm going to draw a line at where 1 month implied volatility is right now, and let's just compare that to where 1 month implied volatility was for Nvidia each of the prior 8 reported quarters. Okay? And the first thing you're going to notice is that we're essentially at a very high level. Higher actually than options premia have been for any of the prior 8 reported quarters. Now, it's not just that options premiums are greater. The value of Nvidia as an enterprise, we can use market capitalization if we want to, whatever measure you want to, but that is also similarly much larger. And we can see that if I just simply put the price in here. So I'm just going to put the stock price in at the same time. Now we can see that. I'm just going to bring those events back, and it's annoying that it erases it each time. So we're not far, really, off of the all-time highs. Now, granted, it fell, 2% today, or not, something in that neighborhood. And obviously, it's not at the all-time highs of 135.58, but we're not far from them, right, at 3.1 trillion. So if you combine the higher options premiums than we have seen with the highest valuation going into earnings that we have seen, and it's not quite the highest. Let's see what it was. Actually, it is. Yeah, because here we are. Earnings was on May 21st, and the stock was, yeah, so this is the highest valuation we've had going into earnings. So it's interesting that, essentially the change in the company's valuation that the options market is anticipating going into this quarterly earnings result is substantially higher than it has been for any of the prior 8 reported quarters. Now, why would that be a cause of concern? Presumably, it's natural that a company that's worth more is going to swing around more in terms of valuation. Now, we're talking about a bigger percent as well as bigger valuation. So to think about this, I'm just going to bring up 2 things. The first is that I think there's a general perception, and often this is true, that as underlying assets rise in price, that volatility declines. And to illustrate this, one way we can look at this is just look at the relationship between the VIX index and the S&P. All right, so we're just going to pull that up here. The VIX is a measure of 30-day implied volatility in the SPX index. And so we can compare that to the SPX index. And sure enough, let's get rid of this lower thing here. And what we can see is that these are anti-correlated. This makes sense. There's a couple reasons for it. There's a path issue and some skewness. But basically, as the market declines, you're going down to lower strikes. There's a bid to puts. So all of this makes good sense. What I'm talking about, though, is realized volatility. And there, too, as markets steadily rise, usually that is a period where we have solid economic data, solid earnings data, good investor confidence. And the byproduct of that is that, we tend to see very low volatility. We saw it in 2017 up until Volmageddon in early 2018. We saw it in 2006 and at least the first half of 2007. So what are we to make of increases in volatility, implied or realized, even as underlying assets continue to appreciate? So I don't have implied volatility data that goes back to my earliest days as an options trader. But for those of you who don't know, I started as a floor-based options market maker, crowd-based market maker in OSX index, and then also as an options specialist, among other things, in the 1990s, the mid-late 1990s. And I bring this up because, of course, that was an extraordinary period for U.S. equities. We had rapidly appreciating U.S. equity prices. It was in 1996 that Alan Greenspan discussed irrational exuberance for the U.S. equity markets. And yet the U.S. equity markets didn't actually peak until March of 2000. And it was in March of 2000 they finally rolled over, and we got what many of us have subsequently referred to as the tech wreck or the tech bubble, and so on. But trading it live at the time, being a market maker at the time, I did notice some things before the market finally did roll over. And one of the things that I observed was that volatility, realized and implied, started to go up even as stocks also continued higher. Now, like I said, I don't have implied data going back that far, but I do have realized data. So let's look at some examples. So this is Cisco. This was Cisco from late 99 until the end of 2000. And what you're going to notice is that the all-time high for Cisco was March 27th of 2000. And here we are in October. Notice that even as the stock started going higher, realized volatility, so they're not implied volatility, but realized volatility started going up. We can see here in February, for example, that realized volatility was almost 60% annualized. It's a big number, right? So how big a number is it? That you're talking about 3% moves a day, that kind of stuff. So really starting to swing around. There are other examples. Didn't peak at the exact same moment, but Amazon, which actually reached its zenith a little bit sooner. Similarly, stock was going up, but volatility was also going up. I think I was looking at Microsoft as well. Same sort of time frame. Let's see if we can find what was going on here. Microsoft also, I think, peaked out a little bit sooner, if memory serves. And look, bearing all of this stuff exactly in mind isn't going to be. So here we have it. The all-time high was actually for this one in December, but we could start seeing that there was kind of an uptick right here. It was not all-time lows in terms of volatility. I looked at Intel, and there were a number of situations that there were vague similarities. Not exactly identical, but circumstances like that. And now I want to take a look at two other stocks. And this is from the present day. This is Nvidia. And it reached its all-time high back here in mid-June. But notice what was going on with realized volatility. It similarly, as the stock rose, was going up. Let's take a look at Broadcom. So why do I bring this up? What do we think might be going on here? What I believe is going on is that as these valuations get higher, there is an increasing amount of anxiety amongst investors that a top could be somewhere nearby. And what that encourages them to do is to sell first and ask questions later. And then if it looks like the market's going to rally, there's the fear of missing out, and so they get back in. And that, I believe, contributes to this realized volatility phenomena. And what I would suggest about that is that, to me, I think this is something you should be taking a look at in each and every stock in your portfolio. If you are observing that these stocks are doing well, and all the fundamentals remain intact and all the technicals remain intact, that's great. But keep your eye on realized volatility. If you start seeing intraday moves, close-to-close moves, open, high, low, close moves that are going up, even as the stock goes up, it's, to me, a little bit like people are playing musical chairs, and everyone's waiting for the music to stop, and there's just a lot more tension in the air. So I just wanted to bring that up because, and all of this came up simply because I was taking a look at Nvidia going into earnings. Big implied move, $320 billion implied market cap swing, represents a significant portion of the S&P 500, a significant portion of the NASDAQ 100. And, if it moves violently, the market's also going to move with it. And certainly that's partially because you've got other names like Broadcom and other AI types of stocks that are likely to move. But it's just inevitable because it's such a big constituent. Okay. So having said that, I thought we might move on to something else that I was also looking at, which is Burlington Stores. So Burlington Stores, which is also going to be reporting earnings and is actually one of the few stocks that seems to be holding up today. So Burlington Stores, if you don't, I'm sure everybody's familiar with the company. I'm sure you've seen their retail stores and are familiar with them. Burlington is the third largest discount retailer in the country after TJ Maxx and Ross. So what's interesting to me, though, is that, and I didn't realize this until I was looking at this earlier today and also over the weekend, Burlington is actually growing much, much faster than those other two. So let's just take a quick peek at that, which I think is rather interesting. So we're seeing, solid 10%-ish top line growth here and some expanding margins. Now I bring up this latter part this is an important thing to keep an eye on because, of course, retail margins can be tough to sustain. Typically not a really high margin business. If you're on the discount side, it could be even more difficult. And if you're looking at this, if you can see this, and I might be able to blow this up a little bit, can I? Hopefully we can get a good look at it. But if you can see what's going on here, the consensus view is that their net income margins are going to expand to a little over 5% for fiscal 2026. This is another one of those companies whose fiscal year ends in January. So really what we're talking about is calendar year 2025. So we're really just talking about next year plus the Christmas holiday in January. But if you compare that to TJ Maxx, for example, TJX, it's not really TJ Maxx anymore, it's TJX Corp. You're going to see that this is significantly greater, right? And you can also see that these kinds of margins are attainable. So this is why I was saying pay attention to the margins, because you'll notice that TJ Maxx actually has margins of close to 9% even now. That's on a trailing 12-month basis. And the other thing about Burlington Stores is that Burlington Stores is expanding. So even as a lot of bricks and mortar retailers have been consolidating, closing stores, things like that, Burlington is actually opening stores. And this might be a little bit interesting, maybe not, but one of the very first things I did was I said, okay, well, let's just take a look at Google News, for example. Oops. And put Burlington Stores in. And see what kind of stories come up. And these are all recent stories. Okay, so Bowling Green, they are opening stores, new stores coming in Chicago, new store opening in Troy. Look, these are all within the last several days. Triangle Towns are going to be opening these stores. So I went through here and I found at least 6 stories of 6 new stores within the last 6 days. I found that to be pretty interesting. And it does speak to the growth opportunity. Now, one other thing I would point out. So they are considered to be sort of in that trade down, slightly above average consumer type of niche. And they're trying to broaden out the number of SKUs that they have. Now, broadening out the number of SKUs and having more entry-level products might not sound necessarily like a ticket to better margins, but in fact it can be, because you can actually keep more things at full price if you have basically stuff that can appeal to all of these different consumers. So I thought that was kind of interesting. Now, as we look at it, so on a valuation basis, even though it's trading well over 30 times earnings, it's actually on a price earnings to growth basis a better value, I would argue, than some of its competitors, like TJX companies. But here's the rub, right? So we're going into earnings, and we can see that a number of these stocks, including TJX, it should be said, have been doing exceptionally well. So we've had actually, in the case of Burlington, and let me see if I can pull does this one have events? You're gonna have to take my word for it, because I don't have the events button on this one. But right here, if you can see my cursor, that was the last reported earnings quarter. Here was the last quarter, and then that was 3 reported quarters ago. I actually did a little calculation and figured out that if you had bought Burlington Stores on the close the day before they report, because they report pre-open, and sold it the day that they did report, each of the last 3 quarters. So market on close to buy the day before earnings, and then sell market on close. You actually, having held the stock for only 72 hours in that case, you would have net profits of 52.5%. But, and I think this is also interesting, What I realized is that if you go back over the course of the last 5 years or so and did something like this, where you just bought the stock before earnings and held it for 30 days prior, in fact, you would have lost money over that 5-year stretch. And why is that? And the reason is because this thing chops around quite a lot. We've had 3 consecutive very good quarters. Top line growth looks strong, and it does seem like margins are expanding. But you can see that if we go back in time, we've had a couple instances where the stock really hasn't performed very well at all. So it lost 13% when they reported their Q4 22 number, dropped 10% back in August of 2022. That was on their Q2 23 numbers. And the interesting thing is that if you then take a look at it, okay, well, 1 month after and so on, what ends up happening is you start seeing a lot more red numbers popping in here. And that includes, by the way, the second to most recent quarter, which was actually a good time to own it. It was a positive result just the day of. So why do I bring this up? Because testing, I went back and looked at about 5 years worth of history. And what I found was that if you had bought call spreads going into earnings for Burlington, about a month out. Now, the thing about a call spread, you have a lower probability of profit theoretically than simply buying the stock because the stock has to rally to see a profit, right? And the other thing is that with a call spread, because you're buying one call and selling another, at the strike where you sell that upside call, your gains are capped. So that's 2 strikes now. So buying a call spread rather than the stock, your upside is capped where you sell that upside call. And secondly, the stock must rise or you will lose money because you're laying out premium. But what I found was that over the course of time, because the gains were greater than the losses with the call spread, you actually would outperform buying a 1-month call spread. So go out to September, for example, to the 20th or thereabouts, going into earnings, than you would have owning the stock. I think that over the period that I was looking at, $1 would have turned into about 86 cents purchasing the stock for those same periods. And you would have earned about 7% on, in the aggregate on the call spread. So what are we talking about here? Well, why don't we take a look at an example? And I bring this up simply because the stock's had a good run and the story's intact. It's one of the most loved retailers out there right now. So if you own it, I completely understand. I rather like the fundamental story myself. I'm just making the observation that sometimes going into a catalyst, options strategies have demonstrably outperformed the stock just through that holding period. So if you don't already own the stock, you're thinking about buying it, whether for the things I've said or anybody else, contemplate using a call spread instead. And we'll get to what you do if you already own the stock, because I think you can probably just get some insurance on it. I think I was looking at the 280, when I was looking at this earlier, it was over the weekend, I believe I was looking at the 283.10 call spread, which actually hasn't changed much in price. It's pretty much right where it was. I think it was 905 based on Friday's closing prices when I was looking at this yesterday. And so it's 20 cents higher. Not meaningful. Okay, so if you own the stock and you've had some gains and you don't want to necessarily realize those gains on that, or you're just looking for some protection, as an alternative, one of the things you could potentially do is protect it, with a downside put spread, similar duration, and I think that should be fine. So I wouldn't buy something that's in the money like this, because you're leaning long. Maybe something like a 270, 230. What do we got here? So that's about $10. I don't even think you need to go down that far. $30, like that. So a 270, 240, $30 put spread, a little bit less than $9, which is approximately how much we were looking at spending for the call spread on the upside. I think that's a way that you could potentially play that. All right, so having spoken about Burlington and talked about realized volatility and whether or not it's a sign that there's pent-up anxiety in stocks and where some additional caution might be called for, I think we will now move on to take some potential questions. So Steve Garcia asks, is Vale best of breed in the basic materials and mining space? Is it worth a long position, attractive dividend? But it appears to have broken a multi-year descending triangle pattern to the downside. So, natural resource companies, if we think that the economy is weakening, that's going to be a more challenging place to be. Vale has, a number of, so among other things, there's some precious metals in here amongst their segments, which I think is, one of the things that has obviously propelled it. So we can just sort of take a look at their various production numbers here. Iron is obviously the biggest part of that, and that's going to be mostly an industrial case. Then you have, modest amounts of gold, platinum, and, copper, not a precious metal per se, but certainly an important industrial metal and, sort of straddling the fence a bit. If we are seeing a weakening economy overall and we expect industrial production to drop, then obviously that's not necessarily going to be a positive. However, at the beginning of the year, I commented that I liked gold, and that's, look, if you were going to try to play a gold company, you'd play a dedicated gold miner, not necessarily Vale. But I don't know that trade is over, and I definitely don't know that it's over if we're going to get rate cuts, which is what Powell was signaling last week, and I think we have every reason to expect it. And the rate markets are implying we're going to get that, right? So all else equal, those things would theoretically be net positives. And, the valuation for the business is quite cheap. And so, I don't know exactly where this is the pandemic lows right here. And, obviously we're not quite down to those types of levels. That's another 40% decline or thereabouts just to get to that pandemic plunge type of level. But, I think, it's not a bad place to be. Let's try to look at this on a different sort of basis if we can, just to give a sense of where we're at in terms of valuation. Because, this is not, the story is not completely over. I think, I'd rather be getting long here, despite the fact that technically we obviously have been in a period of some prolonged weakness. Let's take a look at some of the short-term technical indicators first, before sort of rendering a final judgment. And here we can see it's kind of a mixed bag. Looks like there's still slightly more short than long. But, I would keep my eye out here because, let's see what RSI looks like. Yeah, so RSI was getting in right around here. You can see that was a little bit overdone. Where's the, what was that? Was that earnings? It was, that's interesting. So I'm not quite sure why. Let's take another look at that. What was that gap? So this was first week of August. I mean, the company responded okay to earnings. And, we're still in a little bit of trouble, I would say. I'm thinking that maybe we're going to hold in here around this $10 level. So, all else equal, I think I'd probably prefer to lean on the long side here. in anticipation of, amongst other things, some lower rates. And look, I mean, valuation is pretty good from a historical perspective. But, you know, this is not exactly like a stay long, be long situation. I mean, obviously, if you've been in it for some time, it's been a pretty painful run. Okay, so FinWest, good morning, Mike. Happy Monday and happy Nvidia earnings week. Yeah, this is the big one. I think I think this is the one that everybody's kind of waiting for. Steve Garcia also asked, do you think Nvidia's move after earnings will exceed the expected move? I also noticed from prior earnings that Nvidia tends to move significantly after earnings, meaning one can take advantage of that. And then actually somebody else here has an Nvidia trade idea, and maybe we can take a look at this. So Nvidia trade idea, back ratio call spread with out of the money short put, 2 synthetic calls with out of the money short put. Oh, 2 separate ideas, I'm sorry. So Spicy, if you don't mind, contribute the expirations and the strikes that we're thinking about, and we can stick them in and model them. To answer the prior question, which was, do I think that Nvidia's move after earnings will exceed the expected move? Well, let's just take a look at what that expected move is. And what we're dealing with here, and this is just by week's end, right? So stock's about 126.5, 127. Looks like the implied move now is about 13.25. Actually, it's a little bit lower than it was earlier. I think at one point today it was about $14 higher or lower. So we'll call it 13, just round about 10%. Why not? Now let's just take a look at stock price chart, sort of get a sense of what kind of a move that would represent. So I'm going to go like this, and we're going to indicate, you know, roundabout what kind of numbers we're talking about. So you're dealing with a range that's going to be, you know, between, you know, round numbers again, we'll say it's going to be right in this neighborhood here. So I'll start around 113 or so. It's going to be in here, right? So this is the range that we're looking at according to the options market, basically, right? Right in there. And that's by the end of the week. So quick question for anybody who's interested, and you're thinking, okay, can it do this? Will it do this? My first thing is, can it do it? Violate that specific range? Well, I think actually it probably could, and pretty easily. Why do I say that? Well, take a look at what we had here. We had a 33% drawdown just in this short period over the course of 17 trading days. So, and that did not capture earnings. That didn't have a catalyst. That didn't have a situation that, you know, where they either blew the doors off the number or came back with something really disappointing. And so could it move more than that? Yeah, I would argue it probably could pretty easily. And part of that also stems just simply from the fact that we've had this really big move. That said, do I think it's likely to? So can and likely to are two different things. And actually, I don't think it's likely. And where am I getting that? You know, options markets are usually pretty good because this is, you know, the people who are focusing on how much these things can move, this is where their bread gets buttered. It's essentially, again, what I often speak of, which is the wisdom of crowds. The combination of those who are betting that the move will be as big or bigger than, and those that are betting against it. There's very few securities out there that are trading more options than Nvidia is. So this is a really big data set, if you will. In fact, the August 130 calls, which were the most active option in Nvidia today, so those are the ones that expire at the end of this week, so people buying those calls in anticipation of a positive result. Those were also the busiest single stock option altogether. There was a Tesla option, I think, that traded about 80,000 contracts, and I believe that the 130s traded something like 114,000 contracts at an average of about $6.20 each. What do we got here? Oh, it was even more than that. Okay, so it was almost 120,000 contracts. So what this tells us is that total of 2.2 million contracts traded. So what this tells us is that you have a lot of people committing their capital, betting their money on what the outcome is going to be. So it's a very, it's a very broad survey, if you will. And so, and also the options market's implying a probability of about 60% that is within that range. And actually, that's just something you can think of generally, that whatever the implied move is, that's about a 60% probability that it's inside of that. So is that an overwhelming probability, 60%? Nah, it's not overwhelming. But it is better than 50-50. So I hope that helps. Let's see what else we got here. So August 30, out of the money put, the 116s. Yeah, so let's take a look at those. Forgive me while this thing boots up here. I probably have it open in another window. All right. So what are we looking at here? 267. And so that basically, that's right at that break point, by the way. So 25% probability of profit on the long side for those, or 75% probability of profit on the short side, because they're going to be the inverse of one another. Yeah, I mean, look, if you're long the stock, and I mean, I would probably, let's just do this. And we went through this exact same exercise on last Wednesday. I think we were talking about Lulu at the time. I was actually just asking somebody else about that. But let's just think about this for 1 second. So sometimes the easiest way to illustrate how we feel about an idea is just to compare it side by side with something else. And so let's just say I took a 125, 115 put spread. So essentially I'm going to now short, and I'm not saying that's the way I should go, but let's just say I'm going to short the put very close to what somebody else might otherwise buy. And let's take a look at this. So this now is a trade that costs about 387, and that's 267. Maybe we can do this a little bit differently. I'll just bump that down a little bit. There we go. So now these things are getting closer in price to one another. So now you're going to lay out a similar amount of premium for a trade that's going to start to show profits around 121-ish, rather than down around 113.5 or even a little bit lower. So, that's not an inconsequential difference, particularly when we're talking about trades that expire at the end of this week, right? So $5.50, 5% of the current stock price over the course of 3-4 trading days. I'd kind of rather trade verticals going into that. The other nice thing about it too is that, remember, when you're trading verticals into a known catalyst with a really short expiration date like this, the bet's going to pay or it's not going to pay. When you trade verticals a long time in the future, whether it's a debit spread or a credit spread, they never really seem to work out that great. I'm sure you all have probably experienced this. And there's a good reason for that. And that is because they don't trade to their sort of terminal value. They don't trade to intrinsic until expiration approaches, which makes them better suited for this type of trading, right? So you have an identified catalyst, you have a targeted move, and you know when you're going to take it off. So I kind of like it, whether you're trading a credit spread or a debit spread. This is the shorter time frames are the ones that I would certainly prefer. So again, something to think about. All right, Steve, what happened to Options Action on CNBC? I enjoyed that TV show and it's no longer on the air. I'll tell you what happened to it. So a little bit of history. Options Action as a concept was developed probably around the 2007, 2008 timeframe. And it was Tom Sosnoff who founded, he's more recently founded Tasty Trade, but he founded Thinkorswim. And this was really his big idea. He wanted to do this. And so he teamed up with a producer at CNBC, a guy named Max Myers, who's a friend of mine, or he's a friend of mine now anyway. And they decided to come up with this show, Options Action. It was going to be a 30-minute, once-weekly show, actionable trade ideas and all that kind of stuff. Now, Thinkorswim got acquired by TD Ameritrade. And TD Ameritrade continued to do it. They liked what they were getting out of it. Part of it, of course, is raising awareness for their platform. The other was illustrating the types of trades that one might do on their platform. And, I think it worked out well for them for some time. More recently, though, as the consolidation within the industry has continued, so that includes the acquisition of companies like E-Trade by Morgan Stanley, John and Pete Najarian had Trade Monster, and that got acquired. And there's just been a lot of consolidation. And then Schwab bought TD Ameritrade. And in the midst of all of that, self-directed brokerage platforms were getting very competitive with one another, and zero commissions and that sort of thing. Now, that's not to say they don't make any money on the transactions. They do, usually through something we call PFOF, which is an acronym, and its abbreviation stands for payment for order flow. So the market making community reimburses the brokers for the flow that they send them. So that Citadel, Susquehanna, and so on are essentially reimbursing. It's a controversial practice, but it's necessary because you can imagine that if you have to have essentially no card rate for commissions to attract customers in the first place, you have to make money somewhere. They don't operate for nothing. So the way that works, they get reimbursed for directing order flow. Now, when firms like this are advertising, whether it's on CNBC or Bloomberg or anywhere, there's really two things that they're trying to get out of it. They're trying to improve the experience for their customers, try to educate them. Part of their revenues are driven by trading activity, so to the extent that it encourages that can be helpful. And the other is the war of attrition, which is, customers more likely to be on one platform or the other rather than both. So hopefully you can attract, Merrill is trying to attract them from Fidelity, is trying to attract them from TD, is trying to attract them from Schwab, and so on. Well, once all of these firms merge with one another, at least a portion of that competition has been eliminated, and so the ad spend is likely to come in. And the budgets of these two companies was not going to get added together after they merge. You frequently hear about one company acquiring another. one of the things that management always talks about are a host of synergies. What's a synergy, really? Well, the synergy could mean, hey, these guys focus on equity trading and we focus on fixed income, and so now we bring both in-house. That's one potential synergy, but what's the one that they're really referring to? One compliance department, a reduced advertising budget. We could say shaving the head count, right? So eliminating any kind of duplication. And that applies to staffing and it applies to advertising. If each company spent $20 million a year for a respective advertising budget and a portion of that money was being spent to compete with the other, well, now that they're merged, not only do they not need to spend $20 million apiece, or even $20 million together, which would cut the advertising budget in half, maybe they don't even need to spend that much. Maybe they can get away with spending $15 million bucks. So that's a real synergy to them. It does not necessarily bode well, though, for those that are in the business of selling advertisements, like NBC Universal through the cable channel CNBC. So that is what happened. And we see that it's not just CNBC either. This is a trend that is happening in media generally, and that is that we see cord cutting. So that means affiliate fees for all of the respective cable channels are going down, which is one of the reasons why the budgets of many of those cable channels is being diminished. At the exact same time that that is going on, there is sort of an increased amount of content available more generally, because 20 years ago, people didn't spend that much time watching YouTube videos. Now it's an important source. You guys are evidence of that now. If you're watching this and you're watching it live, you're probably not watching CNBC at the same time. Or even if you are, you're not giving it your full time and attention. So that hurts their advertising opportunity and the advertising budgets. So that's what happened in a nutshell to options action. And options action, unlike fast money, someone's in my ear saying something, but options action was a sponsored program, and many other programs on CNBC are not. So that's what happened. They are trying to bring back options content is exceptionally important. Options traders, those of us who trade them, of course, we care mostly about what's going on with the underlying, unless you're trading vol, which is something I also used to do. But quite simply, we do care about these things. And options volumes have gone up as equity volumes have flatlined or even declined. So a lot of self-directed traders and investors who were busy when the first online programs and availability of online brokers happened during the tech bubble, people that were busy click trading Cisco, a lot of those people have moved on to trading options and other strategies. And so, it is one of the few areas for the self-directed brokerage platforms in terms of profitability. It's an important area, and it's a growing area. So I assume that CNBC is working on that, but kind of above my pay grade, as I'm not an employee of CNBC. Okay, don't you see a big correction in the next few days? And with Nvidia news on August 5th, and the new chip has flaws, which could bring months of delays that I've been hearing about, which could beat but lower outlook. Yeah, so that's a really good point. Excellent point. And if you didn't happen to see it, there have been a couple other stories about Nvidia lately which are not glowing. So I don't know that they're overwhelmingly critical either, but they've been talking about the work culture there. And so I have not been to Nvidia, I've not been in their parking garage. My understanding is that if you go into their parking garage, you're likely to see a number of supercars that have wraps that are in Nvidia's colors, but people are putting in crazy hours over there, staying until 2 o'clock in the morning. Jensen has a very flat hierarchical structure for management at Nvidia, which is good in some respects, because I think a lot of businesses are they just layers and layers of bureaucracy. It doesn't have that. But apparently it also means that there's lots of meetings going on with 30 different people and everybody's vying for Jensen's attention and they get into shouting matches. And so there's, it's interesting to see this kind of not so positive buzz going on in the midst of all of this. And to your point, when you deal with a company that is trading on growth, as Nvidia clearly is, which is riding the AI wave, anything that suggests that growth trajectory is going to slow is going to hurt the stock, is going to hurt the multiples. And two things could do that. One of them is a reduction in spend, and we have heard stories about that. That's actually been going on now for probably 8 to 10 weeks, where we've heard people saying, are we getting a return on our AI investment? And as that slows, then potentially that essentially hurts the demand side. But if you have a technical problem with a new chip, that becomes a supply problem. And so now you're basically facing it on both sides. And I think that's a legitimate risk. So Black Mutt Video, Steve asked if Nvidia could move more than expected, not likely to the upside, but I could see it to the downside. Yeah, well, that's right. I think it is oftentimes harder, especially after a run like this, to blow it out to the upside. First of all, think about what that would mean, right? If it does more than its implied move to the upside, so we're at about a $3.1 trillion valuation, add 300 billion plus, to have a meaningful upside beat, you're talking about Nvidia having a market capitalization on Friday's close of over $3.5 trillion, right? That's what an upside beat means. If anybody's wondering, that means Nvidia would be valued at over $3.5 trillion Friday at 4. You have to have a lot of things line up for that. And like I said, the increase in realized volatility that I'm seeing hints that there's some anxiety with people worried about the downside. And August 5th, I think, demonstrated this, that, shoot first, ask questions later. That's what that uptick in realized volatility hints to me. And when you see that, then I would suggest that the downside move outside of it is probably larger. We can actually see that another way, by the way. We can just take a look at 25 delta calls versus 25 delta puts. Why don't we? So we'll just take a look at the front month. Oops. And we're going to compare these two. So, or we'll just, let's look at this. Let's take a look at 10% out of the money call versus a 10% out of the money put. Wow, those things are trading almost lockstep. That I did not expect at all. I have the same period in here. How about that? That's interesting. That actually does come as a big surprise to me. I ain't gonna lie about that. That's something. I would have expected there to be some put skew, but there isn't a whole lot. Let's take a look at deltas. 25 delta put versus call and see what that looks like. So the 25 delta call, 25 delta put. Well, that's really something. And actually, I'm just going to show you guys something by comparison so we can sort of see what we're talking about. Oops, that's 50-50. So here we're going to go 25 delta call, 25 delta put. This is for the market more broadly. And what you can see here is that that has been widening. It's wider now than it has been basically in here. Another way we can illustrate that is just by showing the spread. So back on the 5th, you saw a little bit of panic in there. But in general, we can see that the put skew is, so that line is 25 delta call versus put skew going back 6 months. And you can see that for most of the last 6-month period, calls and puts were much more closely aligned than they are now. So I'm rather surprised to see it's quite that high in Nvidia. But the other thing I would also say is that a part of that is just that Nvidia vol is just so high. These are big, big numbers. Don't kid yourself. I mean, look at this. We're talking about 3-month implied volatility is almost 60%. That's that is actually realizing every bit of it. So that also is going to have a Nvidia long straddle. That's going to be tough, right? Because if you bought a long straddle, just even an August 30th one, so that's almost $14, but call it 13 bucks. So you're going to need it to move more than that by Friday's close to see profits. More than $13 higher, more than $13 lower. Let's imagine it moves 20, so you're going to risk 13, make 7 in profits on that. If it moves 20, which would be a very big move, I think we can safely say. Yeah. And let me just do this. Aha, okay. So you guys are going to have to forgive me because I'm also going to be on CNBC this afternoon in just a little bit. So this having been very close to an hour already, I'm not going to be able to extend beyond that today. But I hope you found this kind of interesting. Just keep an eye on realized volatility. If a stock is going higher and the realized volatility is going higher, doesn't necessarily mean that the end is nigh, but I have seen that play before, and it doesn't have a happy ending. So it's worth bearing in mind. And just think about what the drivers of it are, right? So if you start getting these gaps higher and lower, you're in turbulent air. And, we don't like it on a plane at 35,000 feet. And we don't like it in the stocks that we hold either. What causes it in stocks is a lack of complacency. More anxiety breeds more volatility, even as prices go higher. And so I'd like to leave you with that thought, and also just thinking about using vertical spreads, like we talked about in Burlington, which is a name I like, but it is trading over 30 times forward earnings. Justifiably, I think 22 to 24% year-on-year net income growth. And right now, with a trailing 12-month margin of about 4.3, that's significantly less than TJX Companies has achieved. So there is room in there for some margin expansion, and we are seeing growth, right? So they're net opening stores. I think that their plan over the next couple of years is to have 100 new stores, and that's net. So you find a couple underperforming locations and you close those down, but 100 new locations. So that should drive top line growth, which actually has been relatively stagnant, and I think is forecast to be stagnant for this reported quarter. But in the longer run, this is the trend that you want to see. So thank you guys all for tuning in. As always, like, subscribe, tell your friends, do all that kind of stuff. Turn on the notification bell in case we do what I hope to do later this week, which is, as I indicated last week, get at least one of these live streams in during the trading day so we can actually take a look at things as they're happening and maybe even come up with a trade idea before the market close. Thanks for watching.